Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy for the early morning update for January 12th, 2021. Let's jump right into the TikTok live trading room here and take a look at the robot. The VCPMI is flashing all over the place this morning. Very active market. Trading last in gold at 1841.70. It's been all over the place, basically. If we take a look at the daily action here, including after making the low of 1817 yesterday, which was a pretty significant turning point, came right into the level of buy one daily. Below that buy one level, we have a very strong harmonic relationship between the daily and the weekly at 1800, 1798. And so this correction was a counter trend correction to test the extreme levels below the mean. And what we have seen here this morning after the market closed yesterday, it rallied up right into the monthly target of 1864, which was expected. The daily target coming in today was 1861, and it was completed this morning at 1:45 a.m. We seem to be getting a lot of activity on the Globix when the U.S. Session is closed, and it obviously makes it difficult for U.S. traders trading in the U.S. Session to take advantage of those moves. So from where we are right now, let me just open this up a little bit here. We completed the targets of sell one daily at 1861 to 1864. These monthly targets obviously have been in place here since the beginning of the month. And what we saw here was the completion of the target and the activation of a short trigger based on a short bearish trend momentum based on the market closing below the monthly average price, and activated also a short trigger on the daily at 1861. So the way that the VCPMI is structured is essentially upon completion of these targets, the market completes the previous pattern targets expected. And so what we're seeing here is that the signal, prior signal from this reversion that occur on the 11th, after the market making a low of 1828, it reverted back up above the average price, and obviously the targets above 1861 were activated when this signal here was produced. And what we're looking at now is simply the market completing that previous pattern. And not only that, but if you were up at 2:45 a.m., then you would have been able to take this short signal here. And so sometimes you can't take every trade when you're trading in the futures markets, and you want to wait, which is what I do for the highest probability trade to be identified within the time frame that I want to trade. And this is one of the things that I really want to kind of emphasize here, and I want to make a point that what I'm doing here is a courtesy to self-directed traders that are interested in learning to trade seriously. I am not making any claims in terms of how much money or how great I am as a trader. But the fact is that I made $1 million last year using this indicator. But that doesn't matter to you as a self-directed trader, and it should not matter to you how much money I make or not make, because that's not my goal. I'm not selling you how great of a trader that I am. I'm sharing with you an intelligence that I'm using that works. And I'm showing you live, and whether the account is a simulated account or my live trading account is irrelevant. You're seeing the signals live right here being activated live and coaching you live of how to interpret and apply the intelligence of the algorithm. So, because what you do with it is up to your profile personally. How you trade it, how you position yourself, how you manage the risk is up to you. What I'm showing you and I'm sharing here as a courtesy is a GPS for your trading that tells you we've come down right into the average price and we've reverted from the average price. Now we've activated a bullish trend momentum. And the targets now, again, of 1861 have been activated. Your protective level is 1839 below. You have 3 stops to choose from. A close below for conservative, a dollar stop, or the end of the day, depending upon your size and profile, how you can manage this intelligence. Ladies and gentlemen, I could not be more clear on providing you with an independent source, an independent tool that will identify the probability factors of the supply and demand for your trading session, which is the core and essence of what trading to me it's about. As a trader, I want to know if I can come in here and day trade. I lay my GPS over, and I know that right now we're at the daily average, and I can look back, I can see the reaction of the market, like I reviewed here, going back to that 1828 level. From 1828 to 1861, that's a pretty healthy range, trading range, that the VCPMI identifies for you. And depending upon your ability as a self-directed trader to take that intelligence and maximize it based on your profile. Not every trader is homogeneous. But what I found in using this tool objectively, away from the chatter of the fundamentals. What it gives me is a mathematical structure, a very defined mathematical structure of a probability model that I can apply daily, weekly, and monthly. I can see where the market is on the weekly, on the daily, on the monthly in relation to one another. And the key is to identify that harmonic relationship on all of the trends that increases the standard deviation away from 50-50 standard deviation to 50-95. And as a trader, I don't care to trade the 50-50 standard deviations in the futures contract. It doesn't, to me, apply the risk or the management accordingly. So the program tells you just go flat when you're trading, when you're day trading in the futures. Just go flat, wait until the highest probability, and that would be either the market coming down to 1822 or trying above again 1861. Now, how you apply this intelligence again depends upon your profile in managing the risk, which is really what I'm showing you here, is how do you apply the GPS for self-directed traders within this mathematical structure, and how do I manage the risk for day trading, if you're a swing trader, or if you're a position trader. I look at all the three trends in the market. Obviously, that's what you want to look at. That's what the market has taught me, that it separates into short-term, intermediate, and long-term. And so the VCPMI, which is the variable changing price momentum indicator, identifies for you this extreme levels, gives you a structure, very specific, daily, weekly, and monthly, that you can trade intelligently from. So the previous trade, coming back to the market here, that we saw from the low of 1828 was completed, and now we've, again, entered into this bearish trend momentum because and also a daily short trigger, and this has been completed. So this short trigger from 61 on the daily has been completed at 1839. Again, back and forth. And if you notice, we are trading between the monthly average of 1864 and the daily of 1839. And right above here on the daily, we have the sell one level of 1861 and the sell two level of 1878, which coincides with the weekly average of 1880, and also here the monthly of 1864. Once again, that becomes the target. Let's watch the market here as it is indicating that we're finding buyers above the average daily. And as a consequence, obviously, the daily short trigger from 1861 was completed. And so now the system is neutral, and now it's activating a bullish trend momentum again. It's not a trigger. The trigger, the actual signal for futures day traders was a close below 1861, And if you understand this logic, which is what I'm teaching and coaching in my private trading room, um, because if you're up, or if you want to trade the Globex and you get up, you see that the market is giving you that signal at 1:15 in the morning, it's up to you. And in trading in the futures, you can trade the Globex, which is the overnight markets. And once again, I want to point out that we are trading ranges of $40, $50, $100 literally in a matter of days. And that's the volatility that we are seeing tremendously increasing as we begin to unfold into, again, in so to speak, trying to resolve this fundamental crisis that we're dealing with health-wise, politically, and economically. I think what happened last week was real significant to America. I believe it's given a lot of academia a pause for concern. When you really think about the implications of what happened, they're really profound. And I believe have shaken the fabric of democracy and the fabric of this country. And I don't believe it's over by any means. As long as we continue to keep open social networks, making it facilitating communication amongst this group that is challenging our democracy, we're going to continue to see this unfold. And it simply is a reflection of what can be done on the negative side when you use the social networks. It's a wake-up call for our nation. And that's my opinion. Coming back to the market here, you see now we're beginning to see buyers show up or unfold on this at this level here, which is above the average daily. So this pretty much validates my position to continue to hold a core long-term position in the market. And again, depending upon your risk, to be able to hold on, because I think prices are going much, much higher. The way that I manage my risk is completely, or may be, and more than likely will be different than yours for your personal account. I may be able to hold on a trade on a drawdown far greater possibly than you. Everything being relative to your profile. And I want to make it clear, if for anybody out there that is executing in real time the signals that I'm producing here, to use one of the stops that we recommend, which is basically to use a hard dollar stop according to your profile. And I use a hard dollar stop anywhere from $600 to $1,000, particularly in this volatile market. So regardless of what happens to the market in a situation like last week, for example, which you would think that after what happened last Wednesday in Washington, the gold market would react. So it is not trading based on the fundamentals. And if you really think about it, based on what's happened since 2086, which was the high that we saw back in August, September, it's not trading based on the economics. Now, you would think, if you take a look at Bitcoin, that Bitcoin is reflecting what's happening to our monetary system. We saw go up Bitcoin. And by the way, we trade the GBTC, which is the Grayscale Investment Bitcoin Investment Trust, which is a regulated security. And I feel a lot better in trading GBTC as opposed to just going through the process of a wallet and this and that and making it very complicated in terms of moving money and being subject to technology completely. And so here, at least, this is a security that is registered with the exchange, and it gives me the same play as Bitcoin. And what we saw here, as you're taking a look at, is the market made a high yesterday of 48.65 and just collapsed. And so what it's trying to do basically is define the next level of support and see if this was a complete blow off, or we headed for much higher prices. So let me take a second here and see what this trend line looks like. It appears that we've come down to a critical level of support on a trend line, and so we are beginning to see buyers coming back into the market again, and we want to see. It looks like this might be a level of support for the time being, but it's a very volatile instrument, obviously, and I think it's a tradable instrument. When you can buy it at 5 back in March and it's at 48 right now, that's a phenomenal trading instrument. But once again, it's not a currency. Coming back to gold, you can see the reaction here since the high of 2089, that it separated and pretty much discounted the damage that was done back in March, and wanted to see now the developments, casualties, pretty much the statistics of how much damage potentially was done. And I think here the market anticipated a lot more damage. And I do believe that we're beginning now to see the kind of damage. I don't think all the numbers have come out in terms of how much damage economically this has done, and how much more stimulus is going to be required. But market coming down to 1767 last year, November 30th, was the bottom, was the low measurement for 2020 that we are using as the basis moving forward. And what appears here is that this leg from 1767 to 1962 That's almost since November the 30th. That's a $200 move. This is what I mean, that the gold market, and let me just say this to you very bluntly, very clearly. This is just the beginning of volatility in the gold market. Because think of precious metals as a pressure cooker getting ready to explode. And what I'm trying to what I follow in order to monetize for myself, for my clients, for my subscribers, is the probability models mathematically that identify technically the completion of these patterns with a high level of probability. Now, what you do, again, and what I do with this intelligence is up to me, it's up to you, it's up to us. But even the market coming down yesterday right into this Fibonacci level of support. These are fan lines, Fibonacci trend fan lines that I use, in addition to the VCPMI, simply to validate and confirm the fact that the signal that was given to buy at 1822 was validated. After a sell-off that like this, where we saw again a high from 1960 to 50, back down again to the low that we made yesterday, 1817. This corresponds to about a 50%, 60% Fibonacci correction of this leg. This correction here looks to be a second leg correction if you use an Elliott wave principles. We use Vedic wave principles, which have 9 wave counts as opposed to 8 counts, which is Elliott wave. But it follows the same process. That this obviously looks to be the first wave. The second wave, usually it's about 50, 60, up to 72% correction. When we resume and establish the bottom of the second, then we begin the third. And we use the basis of that bottom to measure the third. And so if the first move was 200, the third wave should give us about $400 from the low that we made from 1817. You're looking at 2217. I'm sorry, correct. The measurement, if you get the measurement of the third wave is double the first once identified. So if you had a $200 move, we have $100 plus correction within a 50% Fibonacci retracement. The third leg looks to be, if this bottom is confirmed and holds and validates at a $400 move from 1817, that's 2217. Which is the target, and it kind of fits into the upper range of the longer term Fibonacci trend line resistance that you see here, all the way up to even 2263. So what the VCPMI is doing here is identifying the beginning of the third leg. It looks like we came down right into a buy area, a combination of Fibonacci trend lines, Fibonacci retracements. The 1767 corresponded to a 50% retracement from the low that we made in March of 1456.57 to the high of 2089. So it seems that we are unfolding the next seasonal pattern, and this correction was a second wave correction, which is corrective. The second and fourth waves are corrective. So what you see here now is basically the market volatility beginning to increase, but it's giving you short term a bit of a mixed signal for me in terms of when the market again trades between the average price, which it is right now, daily and monthly. And it's also right above it. It's trading on the weekly, below the weekly. We're trading within a trading range of the daily average of 1839 and the weekly average of 1880. It's very clearly defined that the market is in a choppy area. The daily signal was completed, and this is why you see this kind of reaction where the market reverts from once the target is completed right back down into the average price. And more than likely it's going to trade within that average price, which is why the VCPMI intelligence tells you, self-directed trader, you don't need to trade the VCPMI during the average price. Let it define the extreme above or below. And what you see here is the extreme below, and the signal being activated going up to the extreme above, the monthly average and the daily short trigger. And so this is the harmonic relationship, 61-64. I was curious to see what the market does when it gets there, and obviously it provided supply. It provided the opportunity for people to unload some of the profits from 1817, which is supply, which is great, because I want the market to give me the opportunity to be able to buy to confirm, number one, the target completed, to confirm the 1817 to be the secondary low this year so far, holding. Last year was 1767, and we're trying to define the seasonal low. So I think it's pretty clear that we are defining, you might say, the extreme above and the extreme below the market here. We're looking at the extreme below at about 1800, 1822, and we're looking at the extreme above at 1878 to 1880 trading range. And I think that's what we're going to be trading here for the next couple of weeks to build a solid foundation to approach the next seasonal highs, you might say, on the biggest scale. If we get above the 1864 on the monthly numbers, it's very, very critical for the bigger picture that we're looking at, which indicates sell one targets of 1950 on a monthly basis. And what you really saw here in the last few days in taking a look at the excuse me at the monthly indicators, at the VCPMI, at the long-term indicators, what you see here is that the market coming down to 1817.10 almost came down into a monthly buy one level of 1816, which had been in place all this month, since the beginning of the month. And right below this level of 1816, we had the 360-day average price of 1810. So this area was an incredibly strong area, a pivotal point identifying where potentially the reversion can unfold. So when you're taking a look at the 1816 target, the low was 1817. Using a 10% margin of error, it completed the previous pattern, activated a buy trigger, automatically activates the 1864 target. When you're down here, automatically it activates the 1864 target. So you see the market challenge all that supply that is given, buy-in comes in, takes the supply over, completes the Fibonacci targets pattern, and boom, right into the target of 1864, which we've had all this month. And this is a critical area that we've been looking at, because previously, before this big correction, we had some numbers, some resistance to deal with at these numbers. It was support. So now it's become resistance. When support is broken, it becomes resistance. And then we see that resistance out, those levels connect to the daily, the weekly, the monthly, and the 360-day cycles, and the 9-year cycles. So you clearly see here that we are in a congestion area, trading around the average price, short-term, intermediate, and long-term. The silver market is showing more resilience at this point from down here than the gold market, and I want to point out to you that the silver market probably is the most undervalued asset of all the precious metals in relation to any other class asset. So I am recommending in my trading room that you begin to build an inventory based on some silver mining shares where you can hold for the long haul. I think this correction is providing a great opportunity to upgrade your portfolio, to take a look at some of the values, and build at the extreme below the mean so that you can sell at the extreme above the mean. Ideally, when it gets up to that harmonic level, daily, weekly, and monthly, the triple threat is what I call. We're trading the gold above the average here, activating a bullish, daily bullish trend momentum. There are no signals basically for day trading, which it's a great opportunity to show you how I use it or how I apply this here, that I don't necessarily have to take every trade, but to be patient and wait, for the highest probabilities. And one of the things is that depending upon how you manage your portfolio, you can afford to be in the market and to benefit, by the underlying trend of the market. And you don't necessarily have to be actively trading the futures contract unless you get the signals with the highest probabilities. But you are continuing to fluctuate in equity in your core position, obviously up and down based upon the movement of the market. And so in this environment, particularly in precious metals, if you're looking to build a portfolio in precious metals, you have to be willing to allow for the volatility to take place, because it is one of the most volatile markets, sectors, particularly if you're trading with, double X, triple X velocity ETNs, ETFs, shares. But depending upon how you want to manage the volatility risk, you can design, again, a portfolio to suit those goals and criteria. If there are no signals in day trading in the futures contract, I'm comfortable being patient, waiting for the market to activate those signals. And in the meantime, it gives me the opportunity to recalibrate, adjust, average, prepare, whatever position I'm carrying based on what the indicators are telling us. And when you take a look at just what's happened to the market, from a technical point of view, it is indicating now that we have a secondary high, a secondary low, a higher low, which is 1817 this year in 2021. And what the market is trying to define right now is if this 1817 low is going to be the low for the seasonal low, or it could be the low for the year for that matter. For this, unless broken, the market rallying above 1839 confirmed that that was the bottom so far. So unless broken, you can begin to use that number as the basis for prospective speculation in terms of where prices could go, mathematically speaking. The one thing that I want to emphasize and point out to you guys, that what I'm noticing here is that the prices are coming together into this 1822, 1800, 1798 level harmonically on all of the three trends. And that to me is music to my eyes, because what I'm beginning to see is the bottom of the market. This VCPMI, mathematically speaking, begins to identify within the harmonic relationship of all the three trends where the bottom or the top of the market is, based on the relationship of price and the algorithm. When you're looking at the daily, weekly, and monthly, all almost at the same price, which is the 1800, 1798, 1810, 1822, it's a cluster of blue. And when the market price is trading in blue, it's telling you that this is mathematically the highest probability area to identify accumulation of supply, buyers. And so that's what we saw yesterday. And so my conviction is that we are, or are, I would say, almost at the bottom of this counter trend correction that we saw. And, I would definitely use any of these corrections to add to my long-term or your long-term position. Even in the share sector, kind of a mixed bag. It's fairly very quiet here. The E-mini is trading right around the average price. So there's no day trades, and you can see this whole session has been chopping around the average price, and this is what basically 50-50 standard deviation represents. Ideally, you want to identify the trade by going up above the mean into that sell one level of 38.16 to go short, or to buy into that buy one level of 37.71. I trade primarily the gold, silver, E-mini S&P, and we are trading more actively GBTC, which is the Bitcoin Investment Trust, as a trading instrument. And obviously, we're holding on to our gold, but also trading in the gold, day trading, swing, and position trading in the futures contract. There's no trades today. There hasn't been any day trades today that are worth noting here. And so when in doubt, stay out. When there's no trades, then just be patient. Let the market come to you. And that's difficult to do. I know it's easier said than done. I must say, I just kind of realized myself that's easier said than done. That is for sure. And I can relate to that. And that's one of the challenges, I think, of being a self-directed trader, is that you want to be patient to execute the highest probability trade when presented and identified. At least what the VCPMI does for me is it puts the trade into a mathematical probability. And, when I'm taking a risk, just in general, obviously, I want to go with the odds on my favor. So when you're trading, you want to have the probabilities on your side. The signals seem to be just neutral, mixed. The actual signals that occur happened on the Globex overnight, and the market is chopping around, now on the average price. Recently, a recent report basically was published yesterday in the Associated Press. And it's entitled Gold, the Last Trowel Before the Seasonal Spring Rally Above 2000. And I think just to share with you, from a fundamental point of view, the actions in Washington the past week have been unprecedented. It has created a certain amount of nervousness in the market, which is creating volatility. However, stocks continue to move up in the face of all the uncertainty politically. Political issues appear to have overtaken the pandemic in the news, even as COVID-19 numbers continue to set new records in terms of cases and deaths. After the unrest in Washington, there may be another wave of cases from that event. The gold market appears to be discounting some of the early buy-in that came in. Gold tends to suck you into the extreme above the mean and then revert as it did from that 1862 level. At 1817, the question is whether this is going to be the floor for the next rally. The VCPMI daily average price yesterday was roughly around the 1865. We're looking at today at 1839. Yesterday, it matched the monthly average of 1864. And if we get a close above 1865, this is going to be extremely bullish for the gold market. We're looking at the buy one level today at 1822. As we see that from yesterday to today, the buyers or the buy levels are at higher highs. And that's pretty bullish. Last week, the precious metals had a correction in part because the 10-year note yield went up about 1%, up above 1%. Interest rates rose. And this contradicts the Fed's plan to keep interest rates low or at bay, given the massive debt globally for as long as possible. If interest rates rise, then defaults will ripple through the system. Rising interest rates also jeopardize the purchasing power of the US dollar. The Fed really has no choice but to keep interest rates low. If interest rates rose above 1.5% on the 10-year note, then the economy would feel the heat and would not bode well for the tremendous bubble in the real estate market that we have seen. There could be a major collapse if interest rates rise. Gold at 1962 was a monthly VCPMI target. Gold reached that level and then supply came into the market with a lot of short selling, which was largely paper supply. Central bankers have the largest short positions. They have added about 13,000 contracts on the short side of the market, which are all paper supply. The market came down from that monthly VCPMI sell one level of 1950 to the monthly extreme below the mean of 1817. The annual number is 1810 for the VCPMI. We might have seen the lows at 1817. If we get back above 1864, that will confirm that the lows were set in place. 1865 will bring in the daily and monthly, while above 1880 will bring the weekly. We are seeing some kind of a head and shoulder bottom formation, looks like, taking place. There are no trades for day traders today, but it's neutral to bullish. If gold trades above 1865 or 1880, then we can recalibrate. In the meantime, we want to be long the market and add to positions as the VCPMI is looking for the completion of the short, intermediate, and long-term correction. Thank you, everybody, once again for the opportunity to share this with you, and I hope you have a great week. Take care of yourself. Take care of each other. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.